two, three, four.
What's up, everyone? Welcome to Money Market Truth, presented by the Come Up series. My name is Mark from Uncultured Currency, and this is my co-host,
Moh from OTB Clubhouse.
Thank you guys for welcoming us here on the Come Up series. Seriously, really appreciate it. We've had this podcast for how long now, Mo?
I think we started last April.
Okay, last April. Yeah, so we almost a year, coming up to a year. Yeah, this is pretty impressive. So we're really excited to be here. Some of you may know who I am, some of you may not. So we're gonna introduce ourselves real quick, but I'm gonna allow the man with the better beard to go first. So Mo, all you, man, introduce yourself.
So as you guys know, my name's Moh, and I've been trading options for the last 3 years. Prior to that, I had a business that I had to shut down because of COVID. Before all that, I used to work corporate. I have a degree in human resources, and I worked corporate for 7 years. Otherwise, I'm married and I have 2 beautiful children.
There you go. So you're not single? Is that what you're telling everyone? I'm sorry, ladies. This guy's not single. This handsome guy with a nice little beard. So a little bit about myself. My name is Mark. I know it's kind of confusing. There are two people in this come up series now called Mark. Just consider me Mark from Uncultured Currency. I'm a content creator on YouTube. So shameless plug, also subscribe over there as well. Just give a little bit of background. I am a vet. I essentially walked away from my career back in 2021. At that point, I felt pretty comfortable. I was able to lower my expenses, my living expenses. We paid off a lot of bills. We went like hardcore just to make sure we were essentially debt free besides our mortgage. So I was able to walk away from my career and I was able to trade for 6 months until somebody found my resume floating online somewhere and I had a specific skill that they were looking for and they offered me a ridiculous amount of money to do a job that I actually enjoy. So I went back to a 9 to 5. I still trade just as actively as I used to, but first and foremost, I am a retail investor. I started off as a gullible, naive retail investor, like I'm sure most of you probably have, where you were just hungry for knowledge and got played in many ways. But through that process, I also learned how to find my own and got a lot better at investing. In fact, I would say probably for the past year or so, I found out who I really am when it comes to trading and investing. And here I am now. I feel extremely comfortable to be able to sit here in front of this audience, this 71,000 subscribers, and be able to speak confidently around you guys. So yeah, that's pretty much a rundown of who I am. And but before we get started, we're gonna act like this is a brand new show, our very first episode. We just want to kind of give you guys a disclaimer because, like I said, some of you may not know who we are. So we're gonna pull up a slideshow real quick. It's gonna be real quick. It's just gonna kind of give you a rundown of who we are when it comes to our investing style and trading style. You ready for it, Mo?
Yeah, let's do it.
All right. The reason why we're doing this disclaimer is so you have an idea of what type of investor I am and what type of trader Mo is. So you have an understanding. So there's no miscommunication moving forward when we do our show. So, first and foremost, I am an investor first. But investing is very boring. I'm going to be 100% transparent. I have multiple different accounts. I have 2 Roths. One I manage myself. One was with my financial advisor. I have a play account, which I will most likely share on here, where I have $10,000 initially invested with a rule of only investing $3,000 each year into that account. The rest is going into my Roth. And I also have a 401k where my company that I'm with matches. And then I recently started a dividend portfolio. That's it. But like I said, if you want to be successful in this game, investing is overall boring. Historically, the S&P 500 has an upward trajectory. I mean, if you really zoom out on a 5 to 10 year chart, you'll see that the market is always usually going up. But if you zoom in, it looks kind of scary at times. There's years where there's been a bear market and then there's a lot of ups and downs, right? But historically, the average yearly return of the S&P 500 is around 9%. And that's over the last 150 years as of the end of January 2023. Now, the reason why I was saying investing is boring because I like to actually tell people that if you want to invest long term, 5, 10, 15, 20 years from now, just invest into the S&P 500 and call it a day. If you want a little bit of volatility, go ahead and add NASDAQ to your portfolio. But that's about it. In my Roth, that's exactly what I do. I invest into the S&P 500 every single month and QQQ. Now, granted, depending on the environment we're in, I may go cash heavy and I wait for the market to dip significantly before I start adding more into the account. But I can tell you since November, I've been adding again. And then if you want to have some more exposure to various different sectors, look at them. Look at JETS, for example, which is the airline sector, or SMH, which is the semiconductor sector, or ARKK, which is the crap stock sector. I'm just kidding. I know a lot of people like ARKK, but it's an innovative stock, and there's a lot of stocks in there that I just don't like, and I think are not good companies. But as a lot of you know, in 2020, it was one of the best ETFs out there. In 2021 and 2022 has been one of the worst. But point being is, if you want to have some exposure to other sectors, look for ETFs within that. Now, I actually have exposure to JETS in my Roth. That is one of the ETFs I'm invested in. In fact, the reason why I started investing into JETS is because I noticed that after the pandemic, the airlines were one of the few sectors that were not bouncing back as aggressively as any other sector. And instead of trying to figure out which airline company is better, because let's just be real, a lot of them are not very good, and I mean, they lose a lot of money. I didn't want to take the risk of trying to find which company is better. So instead, I just want to get an exposure to the overall airline industry. And honestly, it's been doing fantastic for me recently. And let's say you're just not interested in just investing into the S&P 500, or let's say you're already doing that. You're doing S&P 500, but you want to kind of go out there and you want to learn a little bit more. I would recommend, beyond just the ETFs, dividend investing is fine. I like Procter Gamble, Pepsi, Fidelity Investments, WWE, Microsoft, Hershey Kisses. The list goes on. There's a lot of good dividend stocks out there, especially since the bear market. Some of them have been discounted significantly, where their valuation is very enticing at this point. But what I have noticed, because I have been getting around in different groups and different YouTube channels, and I see that dividend investors tend to have a longer term investment horizon compared to other types of investors. It's a psychological thing. They like the fact that owning a company actually pays them to own it. So they tend to actually hold on to companies a lot longer than someone who just is like a stock picker or whatnot. So if you're interested in learning about stocks, I would recommend going for the dividend investing stock style first before going anywhere else. But let's say dividends is not your style, because I know back in 2020 that was all the rave. Everyone was talking about dividend stocks, like, oh my God, you could buy Pepsi, you could buy Coca-Cola, and it will pay you. And then one day it could pay your monthly bills or your mortgage or et cetera, and you could live off of it. Well, a lot of people came to the realization that to actually have the ability to live off of your dividend investments, you need close to $1 million invested into dividend stocks. And a lot of us didn't have that. So people kind of lost interest. But I recommend going back to it, especially if you have another 20 to 30 years or so that you can invest. But let's say that's not for you and you just want to start investing into individual stocks. Here is my advice, and this is where a lot of people begin to lose a lot of money. They take crazy risks. Invest into strong companies. Look for strong companies if you want to be a stock picker, or invest into individual stocks. Look for companies that have good revenue earnings growth. Look at their debt levels. Look at their market shares, their financial stability, and if they have a competitive advantage over other companies. Now, I have a list of stocks over here, and a lot of this stuff is really subjective. It's up to you. Like, what's your thesis on it? There's Apple, there's Amazon, Microsoft, Johnson Johnson, Procter Gamble, Coca-Cola, and the list goes on. But try to find actually healthy companies, established companies will not go to zero tomorrow. I mean, like, I'm not invested in Apple anymore. To me, I like Apple, but it's very cyclical, so I don't invest into it. But I'm heavy in Amazon, and I like Microsoft a lot, as well as Procter and Gamble. So try to look at to established companies and start looking at their financials, and then invest off of that. Look at the macro level first, and then look at the micro level. Then start looking at the fundamentals, and then learn the technical, so you know where you can get in at. Now, let's say you already have certain individual stocks that you're happy with, and you want to get some exposure to growth stocks. You want to be a little bit risky. You want to live on the edge a little bit. And that's when the growth stocks come into play. But I do recommend, again, I'm not a financial advisor, so you do what you want to do. I'm just telling you what I do. Be very careful with growth stocks and don't have too much exposure to them because it can destroy your portfolio. It takes a lot of skills to try to find good growth stocks that have potential 5 to 10 years down the line. And you have to actively watch them because earnings are important. And sometimes when the macro and micro and the fundamentals isn't working out for that specific stock, best believe is going to get beat up. Look at a lot of these growth stocks that have literally went from all-time high, I'm talking about in the hundreds to like low tens, like $15, like 95% discounted. It's crazy. They're highly risky, but they have a great upside in the right environment. And unfortunately, in the bear market that we were in for the past year and a half, this wasn't an environment for them. However, buying at the right time is key when it comes to growth stocks because you don't want to buy at the all-time high. I mean, look at Affirm. A lot of people bought at $160. Look at where it's at today. It's pretty embarrassing to be honest. But you want to buy at the right time as low as possible, get the best price that you can at the best valuation. And then you probably want to sell if it gets a little too crazy. You want to take profit and cash in. And there's nothing wrong with that. Don't have that impression that you have to hold stuff forever, especially a growth stock. Unless you really believe in it and you just want to, it's up to you, your risk level. And then there's the bonds and the T bills. Now, these are overlooked quite a bit. I don't see a lot of people talking about the bonds or the T bills. The last one I heard was the I bonds. It was all a rave last year. Everyone was talking about the I bonds because you get 9%, 9%, you get 9% locked in. Right now, I think it's at 6%. But there was a lot of shortfalls when it came to some of these bonds, specifically the I bonds. For one, you could only invest 15K, 10 electronically, and 5 paper, and you had to hold it for a minimum of 12 months. And then even then, if you end up cashing out after 12 months, if it's before 5 years, you get penalized by them taking away 3 months of interest that you have earned. So you have to be kind of careful with some of those, especially if you want to have your cash readily available. But if you have thousands of dollars or $15,000 at least just sitting around and you're not planning on using it and you don't need it for emergency fund, it's not a bad place to park your cash. Whereas the T bills, I like the T bills. I like them, the treasury bills, and you can go honestly all of both of these. You can go to treasurydirect.com, but with the T bills, you can actually buy them in some of the brokerages. I think Fidelity, Charles Schwab, I believe, and even TD Ameritrade sells the T bills. But right now, you're getting anywhere between 4 to 5% on some of these. And the good part about that is that you can invest up to $10 million total. So yeah, it doesn't have that cap like on the I bonds, and they have various different mature dates from 4 weeks all the way to 52 weeks. So that's not bad. Taking a couple, let's say $10,000, and you invest it into a four weeks T bill, you'll get 4.5% back within that 4 weeks. That's not bad at all. Now remember, keep in mind there's also taxes and stuff you have to pay on these, but just overall, if you have like a savings account or just a lot of money to sit on the sidelines because you're not comfortable with the environment right now, but you want your money to work for you. And I hear people all the time, they DM me, where should I park my money? Honestly, T-bills is not a bad place to park. Now, again, this is not a replacement for investing. It's, I would say, is a good way to kind of leverage your spare cash that you have sitting around and have the money really work for you. And yeah, so that's pretty much it when it comes to disclaimer for investing, because you will see me here where I will talk about certain stocks or good areas to buy in and etc. But just know that stock picking is extremely hard and everyone should do that due diligence, because I know someone, for example, was like, dude, I don't like Disney. Disney's a crap company. I wouldn't invest into it. And I'm up over 20 some percent right now. I bought in at a good place. I like the thesis that I have established for Disney. Therefore, I invest into it. I think even Mo, didn't you say like you didn't like TSM, right? Remember, I think on one of our episodes, I said I was going to start scaling into TSM,
Yeah.
right? Yeah, and I am up. I think, dude, I'm up 15% or so on TSM right now. I could double check just to see.
So I'll tell you something. Everyone is up right now, regardless of what
Yes.
you bought. So that's one of the things that I keep telling people, which is what I'm going to get next into is my major thesis on the entire market.
Yep, yeah, we're gonna definitely get into it. But yeah, that is a fact. Since this past month, the market's been running like crazy. But yeah, and be careful because there's a lot of people out there now that are using this as a way to say, "Hey, look at my portfolio. I made $150,000 this month alone." but they're not telling you the full truth that they actually lost $1.5 million last year. So be careful with those little marketing tactics out there. But that's pretty much it. Just kind of want to inform you guys that when it comes to investing, the easiest index funds and call it a day, but it's boring. There wouldn't be a show if we couldn't do individual stock picking. It makes it fun. You learn, and sometimes you're right, sometimes you're wrong. So that's all I got. Go ahead for you, Mo.
All right. Do you mind sharing the presentation, or do you want me to share from my end?
No, I got it.
All right. This is my part. So let's go over options trading in general. Anytime you're starting any business, you have a set of practices that you follow. Trading is no different. So these are my principles. You can call them rule, but this is something that I follow. The first one is focus on what you can control. A lot of people, what they do is they have projection on where their trade can go in terms of how much money they can make, or different things that market can do in terms of news, event, volume, but that's something that's out of your control. So the only thing that you can focus on first is position size, which is tied to your risk management. Second is stop loss, which is only applies to day trading. If you swing anything, the rules don't apply. Anything can happen once the market closes. And then the last thing, which is the most important thing, is your attitude. You will have losses, you will have wins. How you react with both of them will impact your career as a trader. The second one is learn who you are as a trader before you learn any shiny indicator. I say that because a lot of marketing that Mark was talking about earlier is based around one key skill or a proprietary indicator or a system. But the truth is, you can have two traders with the same skill, but if one is more aware of their mindset and how they are as a trader, they have a higher chance of winning. Your biggest edge is you and the risk management, which gets me to the next point. Everything in the market moves in terms of news, event, but risk management is the only stable thing that you have that you can control. So it's very imperative that you set those standards for you. Risk management comes with position size, it comes with risk tolerance, it comes with what kind of trader you are. Are you a swing trader? Are you a scalper? Or are you a day trader? Once you identify these things, you can then ask yourself, okay, so if I'm a day trader, what then is my risk tolerance? What then is my position size? And what then is my execution plan? You have to have all that written down and set, because that's the only thing you can control. The next one is more through mindset, and it's stuff that social media has exaggerated, and that's comparison. I know so many people that I've worked with that do very well, but the moment they see other people do better, they start feeling doubtful about their own skills. It could be them making 500 and someone else making 5,000. And then now they want to mimic the other person's strategy. We don't know if that person's making 5,000 consistently, sorry, or if they had a 10K loss yesterday and they're just not even breaking even. So that's the biggest problem. You need to stay in your lane. You don't know what their position size is. You don't know how consistent they are. You don't even know if it's a real trade. So comparing in trading isn't one of the, it's probably a cardinal sin, I'd say. That's one of the things you don't want to do. The next one is discipline. You can be skilled, you can know all the technical indicator in the world, you can know all the macro, but if you don't have the discipline, and what I mean by that is, as a trader, it's more important to know when not to trade than when to trade. A lot of us will overtrade or trade in a choppy market and give back all the gains. So these are some basic principles that I go by every single day. And I will be honest, anytime I deviate from these principles, I will lose. So that's sort of my plan to stay consistent.
All right, so that should pretty much give you guys an explanation of how me and Mo work here on this channel. All right, so the first topic that we're going to cover today, we like to do hot takes first before we get into, I guess, our lessons. Is that what you would call it? Our lessons at the end here. So let's cover some of the hot takes real quick. You ready for it, Mo?
Yeah, let's do it.
Well, here goes Morty. Here goes hot takes.
We got Affirm. What a disaster. Mo, you're familiar with Affirm, right? You used to trade it, correct?
Yeah.
Yeah, man, I used to invest into it. Funny story here is I remember I think it was 2021 or so because Affirm, dude, it went. How high did it go? Let's go
I
look
think
real quick.
100 with their contract with Amazon when that happened, or oh
Yep,
shit.
162. Yeah, $162. This comp wow. All right. Well, I ended up buying around, I think it was 60 or $80 around that range. I started investing into it because of the whole Amazon contract. And I started seeing a firm everywhere. And I was like, this has to be good. Now, again, this was a couple of years ago. This is still when I was very naive and gullible. I didn't really understand the fundamentals properly. I didn't know how to look at the financials. I wasn't thinking macro and micro. I was just strictly looking as, oh my God, it was $162 and now it's at 75. This is going to be a 2 or 3x for sure. And I remember Zay the Welsh strategist, shout out to him. He actually DM'd me, man. And he was like, dude, I don't think that's a good investment. And I was like, what do you mean? He's like, nah, this is good, man. He's like, no, man. He's like, think about it. What type of people use Affirm? And I think I had that conversation with you too, right, Mo? Didn't you tell me it was like what type of people use Affirm?
Yeah.
Yeah, and it's typically people who cannot afford to really buy anything, hence that they will most likely default on a lot of their loans and et cetera. So it's a shame to see this again. I know a lot of people were getting really excited, especially when it started running up here again. It seemed like it went from $10 to $16, and now the earnings came out, and right now is at nearly 20% down. So we'll see what happens here on Friday. But man, it's looking really ugly. And let's go to the next topic. My favorite, Disney.
So I guess we have some issues.
One of my buddies had told me, it was like, I don't think Disney's a good investment. I disagreed. I would say I've been right so far, but Disney just announced that they plan on cutting 7,000 jobs and then slash $5.5 billion in costs as it unveils a vast restructuring. So they're going to do some restructuring with ESPN and the park experiences. Shout out to Capital Mindset. He's one of my buddies. He does a really good analysis of stocks and stuff. And I remember him explaining he's not a bull of Disney, but he's looking forward to the changes that they're planning on making. As am I, and I noticed that Disney didn't do too bad, to be honest, man. And after hours after the earnings, it's close to 6%. And let's go over here and see what actually happened. So Disney reported revenue of $23.5 billion, up 8% from last year, with a total segment operating income of $13 billion, down 7% from a year ago. And the revenue at Disney's linear networks were $7.3 billion, down 5% from a year ago, while direct consumer revenues were $5.3 billion, up 13% from a year ago. Operating income at a linear was $1.3 billion, down 16% from a year earlier, and direct to consumer reported losses of $1.1 billion, down 78% from a year earlier. Now, looking at this, does this even sound good? Not really, right? Actually sounds kind of ugly. But I think with the jobs layoffs and the plan, I think it was the guidance that really end up having the stock run up. My goal initially was to buy it and sell it at 120. It is above 120 right now. Do I think this is the peak? It could potentially be. And honestly, I'll probably start scaling out of some of my positions, but we'll see what happens. The big thing is I know a lot of people thought that Disney would beat Netflix. Am I right, Mo? I think a lot of people were saying that it's going to take some of his market share, right?
Yeah, so my background, like the corporate job I had was telecom, and we used to have something similar to Crave and Peacock. That's what we used to sell. And they did a bunch of surveys, and they had Boston Consulting as one of their consulting firm, and they said people don't really switch. They do what called stacking. So, like, look at myself, or even you. I know you have Disney and Netflix, if I'm not wrong.
I
So
do.
yeah, so if you have kids, automatically you have Disney, and that doesn't mean you're going to cancel Netflix. So people stack. I think what I'll tell the viewers too, if they're new to this term, there's a lot of algo buying happens with certain keywords. There's a keyword that lately has been getting hit a lot is AI layoff. Anytime anyone does a layoff, they automatically go up 5 to 6%, real time or
Yep.
after hours. And
Mhm.
anyone, it's like NFTs. AI, like anyone automatic, okay, they're talking about AI, the company, let's start buying shares. That's what's happening right now. Um, and you just gotta be careful when stuff like that's happening and you see like just people are buying just based on keyword doesn't always end well.
That is true. And remember also, it's because of the environment we're in as well. Because typically when people say, hey, I'm laying off a bunch of people. You would think that's bad news, but you're lowering the business expense. And because we're in this current environment that we are still dealing with inflation and recession coming, that this makes investors feel a little bit more comfortable. But again, I think at 120, it's pretty high up there. I started scaling in, I think it was in the 80s. So I'm doing pretty well on this one so far. But I will say this. I remember when Disney first launched, they had a very, very attractive deal for anybody who first jumped on for the first year. I think it was $45 for the entire year. That's why a lot of people saw their streaming subscriptions increased significantly. And literally, I think they caught up to Netflix at one point, maybe a little bit beyond Netflix. But now we're starting to see some streaming losses because now those packages are starting to fall off. So now people have to pay monthly. Plus, there's a lot of stuff that's going on with some of the content that's on Netflix that makes some people feel uncomfortable and unsafe for their children. So I'm sure some people left because of that as well. But the fact that they are cutting back on the employees and they're planning on reallocating some things, plus they also beat expectations. But overall, I feel like Disney is kind of heading in the right direction. But when it comes to content, still, I don't understand why Netflix is over $300. I know Mark and I had that conversation on, was it IG or on our podcast? It was one of those. Do you remember? Was it IG?
I think it was on our podcast.
Okay, yeah, and I just don't understand the valuation and for the stock to be at 300. But I will say this: overall, Netflix is still a beast because even if you look at the Nielsen's, which tracks like which shows are the most popular and etc. For months, it's always right now. The latest one was from January 2nd to the 8th. But if you look top 10, what do you mostly see, Mo? Netflix. Yeah, Netflix. You don't even see Disney on that list. It's Netflix, Netflix, Netflix. You see Prime Video, Tom Clancy's Jack Ryan, and Peacock Yellowstone, which is apparently one of the most popular shows in the world, from what I hear. And then when you go to even to originals, it's Netflix, 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 and Prime Video. That's it. It's like you go to movies, I think you may have one Disney. Oh, there's a few Disneys. There's Disney, Strange World, Encanto they're still holding on to this Encanto. Encanto did really well, and of course Avatar. But overall, Netflix is still the content king, and they're still spending a lot of money on putting good quality content out there. So I wouldn't argue that case anymore that Disney's going to eat Netflix's lunch. I was on that train for a while, but clearly that thesis hasn't played out, and I have shifted significantly. But I know they're going to make some major changes here at the Disney parks as well, which has kind of been sidelined for a while, unfortunately. So it looks like they're going to start investing more into the Disney parks as well. Next topic is Alphabet. Yeah, Google is getting beat up pretty bad, down 7% on this article is from Wednesday. It was down 7% following Google's AI event. Did you hear about this one, Mo?
I know they had an event, and I know they started dropping early on, pre-market hours, but I wasn't sure what happened.
Yeah, it's very interesting because everyone's talking about Chat GPT, right? Are you familiar with Chat GPT? Yes.
Yeah,
Everyone's like, it's a rave, it's a rave. And Microsoft has been going up based off of that news alone because they're investing into Chat GPT. And it is. I mean, look, AI has come along quite a bit, right? It's creepy how good Chat GPT is. Now, do I think is the be all end all? Not right now. And I was actually holding out on Google for a while. So full disclosure, I actually sold all my Microsoft and Google shares. I was expecting them both to go down. Only one of them is actually going down. So I took profit on Google. Kind of regret selling to Microsoft, but I still have it in my dividend portfolio. So everyone relax. I just know that I knew that Google also had an AI that they were working on that wasn't public knowledge yet. So I wasn't too worried about Chat GPT. But then they had their AI day, I guess, where they were showing off their AI. And this is basically what happened. Let's play this video real quick.
Google's new, highly touted AI chatbot Bard has already made a boo-boo. Introduced this week, Bard was touted in an online ad by Google that ran in the company's Twitter feed. In the tweet, Google described the chatbot as a launchpad for curiosity that would help simplify complex topics, and it included a short GIF video ad of Bard in action. In the ad, Bard is given the prompt, quote, "What new discoveries from the James Webb Space Telescope, or JWST, can I tell my 9-year-old about?" Bard responds with a number of answers, including one suggesting the JWST was used to take the very first pictures of a planet outside the Earth's solar system, or exoplanets. This is inaccurate. The first pictures of exoplanets were taken by the European Southern Observatory's Very Large Telescope in 2004, as confirmed by NASA. The error was spotted hours before Google hosted a launch event for Bard in Paris, where a Google senior executive touted Bard as the future of the company. Google's launch event came one day after Microsoft unveiled plans to integrate its rival AI chatbot, ChatGPT, into its Bing search engine and other products. As for Bard's mistake, a Google spokesperson told Reuters, quote, "This highlights the importance of a rigorous testing process, something that we're kicking off this week, so that, quote, Bard's responses meet a high bar for quality, safety, and groundedness in real-world information." Shares of Google parent Alphabet were down more than 7% in early trading Wednesday, outpacing declines in the broader S&P 500.
Information, and that's the reason why the stock actually started selling off, because people feel like Google's so behind when it comes to AI. And it is pretty scary because, look, Google's been the leader in a lot of AI related stuff, and then Microsoft, but this kind of put Microsoft in the forefront. And I know a lot of these stocks right now, especially the AI stocks like C3 AI or anything with AI in it right now, is running like crazy. Personally, I would ignore majority of the noise. If you want to look at real AI, who are the leaders of AI, I think it's Microsoft and Google. Still and maybe Apple. Apple is like that cool guy who comes into the party late and then gets the party started, because they're always late on everything. But I wouldn't completely write off Google based off of this. Look, I'm happy that Google's going down because I will start a position again. I'm expecting it to get at least to 90 and maybe below before I start buying. But it's not bad where it's at right now, personally. What's your thoughts on this?
So do you remember that event where Elon threw a stone at the Tesla Cybertruck? And
Yes. It cracked? Yeah, it was a brick.
And
Yeah.
so,
No.
This
Yeah.
is when you have to be smart analyzing news. Is this really that bad that you start dumping a stock and then lose millions and billions in dollar value? I'll tell you what I saw on the flow. On the flow, someone bought $1 million in weekly calls, meaning they expire in 2 days. And then big calls came for 103 on Google next week. So there's people that are buying, hoping that this is going to phase off. But again, next week is CPI, so I wouldn't be doing that personally. And I'm just day trading until we see the numbers. But people overreact a lot these days. Since 2020, with social media, everything's changed. People, ever since Elon had that blue check mark, someone made a bot account of Costco and said they're putting the prices of hot dogs up. And I think Costco is down like 2%. So it's like people react fast and the algos react faster.
Yeah, it's definitely an overreaction, I think, in my personal opinion. Now, did they drop the ball with this AI? Yes, they have, but I would not completely dismiss them as if they're a company that's not worth it at all, worth investing. I like Google. I just took profit. That's the reason I took profit. I wasn't sure what was going to happen with the earnings and stuff, and I just want to be safer than sorry. So that's the reason why I end up selling out of it. And funny thing too, dude, AI is getting really good. I've been using it in my videos. I have I changed my voice to Joe Rogan, and I changed my voice to Biden. And it's creepy how good this AI stuff is getting, man. And even you and I both talked about this before in the podcast, the Jerome Powell, the one on Twitter, where it looked so real on everything that he was saying, but it was just a joke and it was like deep fake. We can't play it here because the audio won't work properly, but it's impressive where AI is heading, but it's also extremely, extremely scary.
You all know I'm Jerome Powell, and let me tell you, inflation is a real pain in the ass. I heard some poors on the streets complaining about $8 egg prices. Like I was saying to my good buddy Kashkari that day, what could an egg normally cost man? $10. Just seems like a lot of unnecessary complaining.
Do you think AI is going to replace traders?
Bro, I'll give you.
I mean, it already is, right?
With trader, it'll be hard because there's some decisions that you need to make. Like if you're day trading, you need to make it based on the experience. but mostly it will work. Like, I'll give you a quick example. Usually, when I'm getting something done from a lawyer, a contract or something, and it costs me anywhere from 500 to 1,000. My wife needed a contract made for SOP for her business. It took me 2 minutes on the AI chat GPT to get it done at $0, and it's really good.
Yeah. It's impressive. It's definitely if you had to name 3 companies that would be the leaders in AI, which ones would you bet on?
Bro, I believe in teams and leaders. I think Microsoft and Google will lead. Yes, Google made a mistake, but I wouldn't think too bad about it. And second thing is what I heard about from a great investor. He's like, the next generation of great companies are the companies that we haven't heard about. Does that make sense?
Yes. But those are risky now, right? Because every single AI stock now is running up.
You need
So
to know the
anything.
fundamentals to the core, which I'm not good at, and that's not why I bet on stuff like that. I can tell you that what investors love and what they do based on how they buy during bear markets. So go look at Nvidia, go look at Tesla. They're both up 100% plus in a month, right? And you compare that with everything else that's up 10, 15%. I know that people love these stocks. Compare just Nvidia and AMD, right? You could see the
Mhm.
difference. People love Nvidia. They keep buying it. So when I think it's time, and I think it'll be around summer in the summer when I start buying, I will pick the names that were getting bought when the opportunity came. That's how I would buy.
I agree with you on that one. Let me show you this, man. This is what I'm talking about. See? Look at this massive run. 136% year to date.
Bro, this
C3
dude has
AI.
call sweeps on this every single day. Every single
Really?
day. Yeah.
Yeah, and it's because it has AI. I know about this company because this was one of the growth stock companies that I was looking at back in 2021. Clearly, I mean, I bought in. I think I bought in. I think it was around like the 50s, 60s, and it just kept going down. So I was like, I'm out. I took like a very, very small loss in it because I mean, it's not a profitable company and it's a very small company as well. But just because of the word AI is in it, now it's running like crazy. So try to avoid those unless you have disposable income. You don't care and you want to YOLO it. That's on you. Me, I like to be risk averse. This is something that I would not keep my eye on. I'm looking at the bigger picture and who the leaders are going to be in AI. And like you said, like Microsoft, Google, yeah, even NVIDIA and AMD, I mean, they're going to be a big player in this space for sure. I would even say Meta is as well. But yeah, that's all I got. Those were the hot takes for this week.
What do you say we cut the chit chat a-hole?
What you got, Mo? Let's hand it over to you.
So the way I wanted to do this today was I wanted to go macro, and then next week we go in teaching you micro stuff that you can use right away. You watch our episode and then you're like, okay, cool. I have takeaways. This is my homework and I can apply it and improve my trading. That's sort of my goal is. So macro, I'll tell you what's happening in the market. Before I say anything, I'll let you know anytime anyone goes bearish in the market, there's a 80% chance that they're wrong. And the reason for that is funds, institutions, they're always long, and market overall will always go up long term, right? So for the last, I say about 1 year and 2 months, I became bearish last January. I've been bearish. Before that, I was always bullish. So it's not one of those people that you see that every time I see you, I'm always negative or I always think that the market's going down. The macro is such that I cannot be bullish, and we need to go a lot lower before we go a lot higher. And there's a couple of reasons for that. Mark, are you able to pull that slide? Okay, so right now, everyone thinks that the Fed's pivoted. And because of that, they started buying. That's one reason why we're rallying. Reason number two is if I'm a fund and I need to get new clients, the only way is to do a better job than what the indexes are doing. So if SPX is up 10%, I better be doing at least that. Because if I'm not even
Mhm.
doing that, someone like Mark could just be like, okay, I could do this myself. I'll just put the money in SPX and QQQ. So when the market started running, the algos started buying. There's CTAs level, which means there's levels where the algos, where the funds will just automatically start buying, right? So that's why they've been buying. And because they've been buying, all the people that were sitting on the sidelines, they caught the FOMO as well. So institutions are
Yep.
buying because they don't want to lag behind the indexes, and people are buying because they don't want to miss out on this run. And now here is a situation that most people don't understand. People that are trying to short this rally are actually providing more liquidity to the market. And the way this works is, let's say I'm short something, right? I bought option and I'm short. Market's going up. Because the market's going up, my option is running out the money, which is removing the delta downward. So if my delta was 40, because I'm moving out, the delta is going down. Because the delta is going down, the market maker who's making this market, they have to always stay delta neutral, which means they have to buying back these stocks to stay delta neutral. At some point, these guys will sell the people that are losing money on puts. That causes short covering. And that's when you see these big 100, 150 point zip rally within an hour, 2 hour. This is what's causing the fuel to the fire. Until people stop shorting this and let this cool down, the market's going to go up. We had Powell. He was very, very clear on what he wants. He wants, let me read specific words that he said. He said higher for longer. Those are some key words he said every single time. But the way he's been saying that, the market hasn't accepted it and they haven't reacted very negatively to it. They're taking it casually and they're buying it. Now, every single event we have, right? Bears accept for it to go down. So they start buying puts, right? They start buying puts. Just this week, I saw about $40 million in puts for March, right? 40 million is a lot for an opening position for puts. What happens is, I'll give you a quick example. Let's take CPI. CPI comes and let's say we match or it's not bad. Once the news comes out, doesn't matter good or bad, the IV will come off. It's called event wall. It'll come off because the whole point of IV being high is because of an event. Unless the news is really bad or really good, the premiums lose value both ways. Calls will lose value, puts will lose value because they are including a higher premium because of the news. And because the news is over now, the volume comes down. When that happens, someone who, let's say, has 8 million is now down 2-3 million. They're like, okay, my hedges, let's take it off. Once they take it off, we run. For the same logic that I told you about event wall coming in, the market maker has to stay delta neutral. They have to buy back. Plus, they're closing the puts and the short squeeze happens. So a lot of people are going very bearish on CPI, which is fine. But if the news isn't bad, meaning if inflation actually went down or stayed the same, we're going to rip. Another factor to this is there's a very big investor. I believe his name is Ian Calm. I'm not sure how to pronounce it, but he made a bet on 40-50 puts for September 17th for 50 million. So he bought 40-50 puts for for February 17th for about 50 million. That's a big bet, right? So these are things that we watch on a higher level on what's happening, and then we try understanding why the market participants are acting that way. Just because we are bearish or I am bearish on the macro doesn't mean that me and Mark every day get in and start buying 0-day puts even when the market's running. We're not doing that. We are letting the market tell us what it wants to do. Once we see our levels break, we'll start getting in puts. And that's how my investment works too. My logic is this, which you're not going to hear from most people. I'm not trying to buy stocks when SPX hits 3,200. I'm trying to buy when there's confirmation. So I'll likely pay more than most people, but I want to know a confirmation. I don't want to have a risk of thinking that this is the bottom and we go lower and then I keep averaging down. So that's sort of the difference between my style and what most people do. Second thing that I want to let people know, a lot of trading is focused on indicators and how much money you make, which is not how you actually trade. Most of the trading should be based on your own mindset, who you are as a trader, and what your risk management style is. If you don't have the base and foundation set, no matter what money you're making, it won't be consistent. And you're going to burn out because you're going to do different strategies because you'll be following different people because you're following money, not the actual process. But yeah, that's sort of what my process is of what's going on right now.
Yeah, no, I'm glad you actually explained that. See, this is one thing you guys will learn about our show. Me and Mo do not always agree with one another. So he's very bearish. So overall, you still think the market is going to tank, right?
Yeah, but it will be on a non-event. I don't think the data numbers actually cause it. It most likely will be something else. And the reason for that is, bro, we're so overhedged, like about 40 million puts already. Unless the numbers are extremely bad, market can't go down. If we all think market goes down and we're hedged, market doesn't go down. That's usually how it works. It needs to be an event that not planned.
Yeah. And again, this is a trader's perspective, right? As a investor, I agree with majority of what Mo was saying, right? I rather wait for confirmation that the market has turned around versus constantly trying to buy or think I bought the bottom or thinking that we're in a bullish environment. That's just me. Now you're probably saying, "Wait a second, Mark. You just said that you buy stocks." I do buy stocks. So just to be very clear, I have an account which I will probably share in here time to time. I do share it on my on Culture Currency YouTube channel, but I am very specific. That account I invested $10,000 in, or I put $10,000 in there, and I invested. I had a terrible last year. Actually, it was 2021. It was Meta, Square, and Roblox. I went way too heavy in them, and that nearly killed my account. I'm back up over $6,000 now, just based off of kind of catching the low on some of these stocks, as well as cover calls, vertical spreads, and cash secure puts that I've been doing, which I'm going to talk a lot more about here on this channel because it's also a way you can trade and leverage your account and take less risk than just doing, puts and calls. But I will say this, Mo, like what I was looking for, key levels, I was looking for to start actually putting a little bit more capital to work was on SPY 410 and 415. If it could hold above that, I would get the warm and fuzzy feeling and I would actually start buying a little bit, right? Problem is that it hasn't been holding. It seems like it does every single time, but then it ends up dipping because I think on Wednesday dipped to 410, right? And the day before that, I think it went way below 410. I believe it was aggressive. It went to one like 417 or something, and went all the way back down, then went all the way back up. It's a crazy, crazy market, and I feel that this is a potential setup to get people screwed in one way or another.
Yeah. So right now, like the example of the market is a shiny car where all the garbage is under the hood. And what I mean by that is most people are watching equity, but no one's really watching. When I say no one, I mean most retail trader aren't watching the bond market. The yield is going up, the dollar is
Mhm.
going up, everything indicating a big divergence, which if it's complicated, it's just basically simply saying that the macro isn't looking good. And macro doesn't often happen the same day. If the macro looks bad right now, it might take a month, might take a week for it to actually impact the market. But we need some sort of data for people to react. It can't be like we're all bearish, the market will go down. We're all bullish because of Powell and what he said and what people, other Fed speakers are saying. That's all like looks very good. Like the casuality, like I don't know if you remember the Jackson Hole event, like he was very stern. His statement was basically, I'd rather over tighten than stop now. But then he completely changed his words and his
Mhm.
tone. So now I don't blame people that are buying. That's my other thing. But I'm okay missing out. I'm okay waiting. I'm okay paying for more. You guys go ahead and buy now, and I'm okay with just trading. But macro look bad. The only reason, Mark, I wanted to talk about is a lot of people might think because we started our podcast last year, people might think like these guys are always bearish. We're not always bearish. The
Correct. We're not.
market is, if you met us in 2020, I was thinking Neo goes to 100, Netflix going to 1,000. Like that's sort of what the trend was. The momentum was everything's going up. People are just buying, buying, buying. And yeah, that's kind of, you need to know the perspective why we're like this. The macro isn't supporting what's happening. And Tesla goes back to 100, right? It might trigger a lot of people, but that's my opinion. My opinion is Tesla will go back to 100 and most likely hit 65 before things change.
I know people right now. What 65? Yeah. So let's be very clear about this. So we've gotten that a lot. Trust me. And who knows? We could be wrong in the future. But from 20, what was it, 20 January 2021 I got bearish on Tesla, and I think you were as well. And I think Tesla at that time was 300, and we said 150. I think you said lower. I think I said 160, and you said 150, and it ended up blowing way below that, going down to $101 before it bounced, right? And I still think right now that it's going to go to 65 right now. That doesn't mean that I think long-term Tesla is not going to be good or that it's not going to run up. And that's another thing I want to emphasize on, and that's why we put the disclaimer right here. Stock picking is hard, and stock picking is fun, right? Everything Mo just said applies to a day-to-day basis, right? Because you go by whatever you see and whatever the market's giving you, right? Again, like I said, if you want to be a long-term investor, SPY or S&P 500, QQQ, call it a day. It doesn't matter. That's it. You don't need to watch the news. You don't need to listen to anybody. Just do that. Call it a day. You're done. But that's boring, right? People want to know a little bit more. And that's the reason why we do stock picking, because it is fun. And there is a chance that you could have a great upside if you get your thesis and your fundamentals right. But like Mo said, macros hasn't really changed much, right? It hasn't. We're still dealing with high interest rates. We're still dealing with inflation. We're still dealing with incompetent administration. We're still dealing with a proxy war with Ukraine. We still have some supply chain issues. People are still getting fired left and right on all these tech companies. I'm pretty sure those job numbers were inaccurate somewhat, right? I know there's rumors going around that those numbers were significantly inflated. They've been supposedly significantly inflated for over a year. So there's still a lot that I think we need to look at the bigger picture instead of just the short term, if that makes sense.
And Mark, to your point, like the unemployment numbers, if you've been unemployed for more than 6 months, they take you out of the system, so that it won't show up in those numbers. That's why.
Really? Okay, that's news to me. I did not know that.
And second thing is, people think the pivot will happen when the rates are cut, and this is what I was talking to with Mark too when we were on live. Historically, the market actually bottoms 6 to 12 months after the rate cuts happen. So whenever they halt, that's historical. That's not me making it up. But ever since the market was created, 6 to 12 months after they pause the rates.
Correct. And I remember, I listened to Jerome Powell speak the other day, and I think there was no indication that he was going to stop after this year. Like everything that, at least what I heard, he said higher for longer. Those were his words. That's what I heard. That's what I heard. I know everyone has their own interpretation. That's what I heard. I didn't hear anything positive. I know he has these little certain words that he will use to try to, soft landing, all this other stuff. But what I heard was, we're not stopping this year. So that's all I got on that. You got anything else, Mo?
That's it.
That's it, guys. So this was our show. Just real quick, I want to kind of give you guys an update how we run our show. We do it bi-weekly, so it's not every single week. I think you misspoke there for a second, Mo, where you were like next week. No, we do this bi-weekly. This month of February, it's just going to be the two of us. But starting March, what we have been doing in the past, there will be 1 week. It will just be me and Mo. The following week, we will have guests on. So look forward to that. We will have some pretty interesting guests. We got our first guest already lined up. I'm not going to tell you who it is. It's pretty exciting. It's kind of a big deal. I have interviewed him before in the past, but he's a trader and he's got a wealth of knowledge. Good dude, solid dude. So he's going to be our first guest for March. So we look forward to that. You got anything else, Mo?
Well, I was going to say that a lot of people do a lot of general information. We won't. We'll give you specifics. We'll tell you how we get the numbers. If Mark's give you a number that he's buying at, he's going to talk about how he got to the numbers. There's no magic ball or crystal ball that we get numbers from. It will be all given. We will also, time to time, go over our lunchbox play, which will be specific plays that me and Mark are looking at and how they fit the criteria that they're being announced or looked at. So you're going to go through it, like, what's my A+ setup? So we'll go all over that in 2 weeks.
Yep. So then again, everybody, thank you for tuning in. We see you in 2 weeks. Until next time, make sure you subscribe and, of course, follow us on Instagram. Take care. Bye-bye.
That's Hunter. That's 100.